In this lesson, we're going to study the correlation of variables in real estate economics. A real example. Suppose we have the following table. Table C is the year that we are in. Table D will be the GDP growth percentage-wise. E will be the average price of the apartments in US dollars. For example, it can be all the one-bedroom apartments in zone A or B or C of any given country. Column F will be the rent rate per square meter, 6.5K US dollar per square meter or $7.6 per square meter and so on. And column G will be the vacancy rate percentage-wise. Okay, so let's see how correlated are these variables. Let's compare the average price of the apartments with the rent rate per square meter. So let's write here correlation between the average price of the apartments and the rent rate per square meter. Obviously, these two variables will be very much correlated. There will be a positive correlation because the higher the rent rate per square meter, the higher will be the rate, the price of the apartment. So we can use an Excel built-in formula, which is Correl for correlation, Correl, and we will select our two variables, array 1, comma, and array 2. And we can see that effectively they are very much correlated, almost one. There is almost a perfect correlation here. Let's plot this graph to see that it will be almost a perfect line. The dots will be cluttered, will be very much together, almost forming a perfect line. So insert chart, here we are. Let's move the chart to a new sheet. So, sorry, move chart to new sheet so it's more visible. And we can add here the trend line, okay? So we can see there is a positive slope because both variables are moving together in the same direction. So as the rate of the price per square meter increases, so does the price of the apartment, obviously, because that's how the apartment price is calculated. Now, let's see another example. Correlation between GDP growth and vacancy rate. So in this case, common sense indicates that as GDP grows, the economy improves, so there is more revenue, more income in the economy. So most probably the vacancy will fall because the people who potentially can rent those vacant apartments have more income. But the strength of this correlation will not be as strong as this one because there are many other variables that can affect the vacancy rate. For example, it's not only GDP, it can be monetary policy, interest rates, household income, population growth, migrations, number of apartments available, and so on. Many other things. So let's use the built-in Excel formula here, Corel for correlation, and we will select our GDP, array 1, our vacancy, array 2. Let's select, yes, okay. And you can see that the correlation is negative as what we're saying, and it's not as strong as the first correlation. Now let's plot this to see visually how correlated these variables are, and it will show plots in the graph that are a little bit dispersed. It will not be as cluttered as the first one because it's not a perfect correlation. It's not as close as the first one. So insert graph. You see, this is how the lines are a little bit dispersed. They are still correlated, but not as correlated as the first case. So we can add here to show the axis. This will be, what will this be? This will be the vacancy rate, the y-axis, vacancy rates, and this will be the GDP growth. And now we can add the trend line to show that the slope is negative because as the GDP increases, right, it goes from 1, 2, 3, 4, the vacancy decreases, goes down, right? Let's add here even to show the vacancy values, data tables. There we are. You see? These are the vacancy values. So the trend line is negative because the slope is negative. So I hope this lesson was useful and is hopeful for understanding correlations in a real case scenario. Thank you.